Welcome back to CMB Connect, the podcast for candid conversations with mortgage leaders. I'm Val Buresch and I'll be your host today. Hello everyone, I'm Val Buresch and this is our fourth episode of CMB Connect. And today I have a very special guest, Diane Jenkins. Hello Diane and welcome to the show.
Hi, thank you. I'm happy to be here. My name's Diane Jenkins. I work for Asurity, and we prepare mortgage documents. So in that capacity, we deal with lenders directly and help them with questions on loan products and on the documents.
So where did you get your motivation to earn your CMB designation? You're one of the newest certified mortgage bankers who joined our society. So can you give us a sense why you did that and how has this enhanced your perspective on the compliance challenges that our industry is facing today?
Yeah, I felt like there was a gap in my knowledge. When you work in one sort of niche area, you don't see all of the other pieces of it. And I think having that understanding of the whole process, particularly the secondary market and servicing and things like that I don't necessarily deal with, really gives you a better understanding of what you do. And so I wanted to do it mainly just to educate myself on all of those pieces. And I would say I noticed I went to the MBA Legal Issues Conference last month, and I picked up on a lot more just having, prepared for the exams and talking to other people about other areas that I wasn't familiar with. So it's been a really good experience, and I think it makes me better at my job, having a broader understanding. And of course, the other piece of that is just getting to know people in the industry, peers, and having that network and people that you can reach out to with questions. And so it's been a great experience. Really glad I did it.
Very well said, and I can relate to that. For me, CMB designation gave me a framework where to put further learnings, and I see it's like the CMB is a blueprint for continuous learning in mortgage banking.
Yes, it really is, and I think it just it forces you, I guess, because of the different topics that you've got to learn to prepare for your test. It really forces you to take a look at some other areas outside your knowledge. So really worth doing, and I would encourage everybody to look into doing it.
So can you tell us a little bit about the type of clients that you're serving and working with them? What are the top compliance issues? 2 or 3 of those compliance issues that your clients are struggling the most with?
Yeah. So we deal with mainly lenders, but we do some servicing loss mitigation documents as well. And because we are preparing documents in all 50 states, we are dealing with people that are lending in different states. And sometimes they're new to a state and they need a lot of hand-holding. I found particularly people who are new to Texas, which is where I am based. And Texas has a lot of peculiarities in their law and requirements, particularly around homestead. So I see a lot of people not understanding the Texas laws around home equity loans and the homestead protections that we have. And so that is really a matter of educating them on how they can be done and sort of the limitations on home equity loans and things like that in Texas. So in that case, it's really a matter of educating. And we do webinars for their employees to make sure that they understand Texas law in that respect. So some of the other issues I notice is when people are getting into new product types. And a lot of times, like for instance, in COVID, there were a lot of new programs that people had to implement quickly, particularly in the loss mitigation space. And not always a lot of guidance on it and a short time frame to implement it. And so, trying to get a process together, make sure they're understanding what they need to do, is a little bit of a challenge. But I find that people in the industry they really do want to understand the correct way to do things. And they're really good about reaching out to other people. And so I think our industry is used to having to deal with compliance issues. So they're very at least aware of the compliance piece of it and, take that into account whenever they're setting up a new program or whenever they're, starting a new process. So.
Yeah, you mentioned loss mitigation, and this is a word and a concept that in mortgage banking we know very well. But if it is someone who's listening to our podcast, if it is someone outside of the industry, how would you explain loss mitigation to such person who's coming new to the industry?
Right. So when people are struggling to make their mortgage payments, of course, the primary goal is to be able to keep them in their house. And so there are a lot of avenues for doing that. And there are things like modifying their mortgage to bring it to a payment or an interest rate that lowers their payment so that they can manage it. Or there's also partial claim products, which helps that it'll pay off the outstanding amount. So it sort of brings them back to level set so they can get their head above water. Sometimes those are done in conjunction with modification. So it's products like that are short of foreclosure, right? You're helping the borrower continue to make the payments, but finding a way to help them do it. And as I mentioned in COVID, we had a lot of COVID specific sort of short term products that the industry needed to implement. So things like that, forbearance plans. So ways to keep a struggling borrower who's defaulted or is in danger of defaulting from going to foreclosure.
Yeah, and I just want to dig a little bit more. There was a wave of foreclosures in 2007, 8, 9, even spilling over. But since then, those volumes have gone down, and it is mostly because of those loss mitigation activities, the involvement of regulators, the government, local, federal, at every level, nonprofits, people, and the lenders and servicers themselves are becoming much more proactive in those activities. Would you agree with that?
Yes. And I think part of that problem back then too was that, there was not a lot of regulation. And so, people were getting into loans that they really couldn't afford because there was just no limitation there's no ability to repay things like that we have now. And so we have come a long way since then, and we are now a lot more careful as an industry about qualified borrowers. And so I think that's helped for sure reduce that problem. But then we've also, as we just discussed, implemented a lot more loss mitigation programs and options. There was really just a couple programs back then, and now there's such a wide range of them that there's really almost always a way to help a borrower that really wants the help stay in their home, which is the ultimate goal.
Speaking of change and the aftermath of the financial crisis, I read in your LinkedIn bio that you were involved in implementing the loan estimate and closing disclosure.
Mm-hmm.
So those are, if you can just give a background what those are, and what, if you can share some lessons that you saw, that you learned, that your clients learned during the process of managing change, managing that implementation of those new requirements.
Yes, that was a huge change for the industry and a really, really big lift. So CFPB came out with the idea to integrate the TILA and RESPA disclosures, and they, this replaced the GFE and the GSE and the HUD one. And the CFPB was calling it "Know Before You Owe," but everybody else sort of called it TRID.
Yes.
and so there's a loan estimate that's given initially, and then a closing disclosure that's given prior to closing. And so the idea is that they are going to disclose all of the fees and the payments the borrower can expect in a manner that the borrower will understand. But it was quite a challenge because the regs were very complicated. There wasn't always a black and white answer on how to do it. And of course, this is new to the industry. So it was a really big lift. But I think the industry came together, and we, like for instance, I know we had a big working group of vendors that were doing this type of thing, the same thing that I did, that needed to program these, that we met weekly to talk through all of the sort of issues we were seeing. And we actually had the CFPB representative come and speak to us to answer some questions. So I think we really rose to the occasion. I was very proud of us for sharing with each other, even though we were competitors in some cases. We really collaborated on this effort to get this across the finish line. And so it was, like I said, a lot of programming, a lot of calculation. So it was really a lot of heavy work that needed to be done. But I think we did a great job. And it's still, the CFPB wanted this to be a document that our borrowers could readily understand. I'm not sure how many borrowers actually read them, but I think, there's certainly a lot of information in there. And I think that we did a good job getting this put in place. So,
Do you think that lenders are all set with the three compliance, or are they making
well,
still mistakes?
I know. I think that, we do still get questions occasionally. I think, in particular, if it's an unusual situation. For instance, we spent some time recently implementing buy-down programs in our documents.
Yes.
So it was a little bit complicated to learn how to disclose those because, of course, there's the initial payment that the borrower is going to be making while the buy down is in effect. Then it goes to their regular payment afterwards. And there's different rules based on who contributes the funds and whether it's the borrower or a third party. So things like that, I think people really have to dig back into the regs to try to figure out and maybe consult an expert, which is what we did. I think for the sort of bread and butter typical loan, people are pretty well versed in understanding how to handle them. Occasionally, we will still get questions on the tolerance requirements, which fees fit in which bucket. So therefore, what is the tolerance for if it changes? But I think for the standard loan, I think that we have a pretty good understanding at this point. Of course, it's been, 9 years or so since it was.
Yes.
So, it took a while. It definitely took a while.
Yes.
So,
But it seems like, based on your example with the buy down, that there is never a down moment
no,
in your
there's
world.
there really isn't. And I think that's one of the things I find interesting is I feel like at this point, I would have, I mean, it seems like you would see every question that could come up, but there are still things that come up that I just hadn't thought of. So, a lot of nuances, especially when you're doing something unique.
Yeah.
And I think in this environment with the higher interest rates, lenders are struggling to maybe try to implement some kind of unique programs. And so those can somewhat be interesting to look at.
Can you explain, when the lender discloses, puts on the loan estimate, the interest rate? Is that the interest rate that was the actual interest rate that will continue, or is it the reduced interest rate?
Well, so it has to be really, you have to sort of disclose the whole, like, for instance, if you have an ARM loan where it's going to change, then you've got to disclose the different options and the ways that it could change based on you've got to say, these are the maximum rates it could go to. This for this time period, it will be this, but in this time period, it could go up to this. So I think those kind of loans are the most challenging. Like I said, the buy downs or the adjustable rate mortgages, when you're going to have a lot of changes in the loan program through the life of the loan, because you don't always know. So, you do the best you can, and you really need to disclose it as what the parameters are for that loan, and the worst case scenario, essentially.
How do you work with development teams at mortgage lenders? How do you work with them so that when they're designing those loan programs and or products and they're rolling them out, that they are actually compliant from the start? Because it's the worst is if
Yeah,
somebody has
yeah,
not thought through something, and
right.
then there's so much waste in terms of resources, of time, and compliance headache.
Yeah, you don't want to get very far down the road before you've looked into kind of the basic compliance issues, right? Because as you said, it can be a waste of time, money, effort, if this is something that can't be done. So we have a product development team in house, and we work with the product development teams for clients, and they will give us the parameters as to what they are looking at doing, and it's a really a conversation as to,
Mhm.
this is something that we can do. This is something I see an issue with because of this, but I think you can do it this way. So try to offer suggestions. It's very rare that we have to say, well, there's just no way to do this, right? So typically it's just a back and forth, as far as feedback from us on the compliance aspects and the issues that they might have to deal with, the things that might arise. Um, so yeah, it's a collaborative effort, I would say. We have a really good working relationship with a lot of our clients, where they come to us pretty quickly, and at the onset of an idea that they have, so that they can get some feedback on it.
Where do you see mortgage compliance heading in the next 6 months, in the next 5 years, in the next 10 years? I mean,
Yeah,
nobody probably knows what is going to happen in a decade, but 6 months to 5 years, let's say.
yeah. It's hard to know, obviously, but I think things were slightly up in the air when the CFPB was challenged. The structure of the CFPB was challenged, but now
Yes.
that the Supreme Court has said, has reaffirmed their constitutional, and I think that was a good thing. I think we've spent a lot of time. TRID, as an example, preparing for things, basing a lot of what we do on things that the CFPB has, guidance they've given, regulations they've enacted. So I think that now that they have re-strengthened their authority, I think that they're going to be out in full force, and with the government backing, and so we sort of need to be prepared for that. But I don't anticipate things changing a lot. To, we had a very big change, as you said, post 2008, because we didn't have a lot of regulations and guidance in place. But now that we do, I think it's just going to be a matter of adapting to any change in the guidance that they're giving. But I can imagine it getting more regulated, as I think we're already very highly regulated. So
Is there any way that lenders can anticipate regulatory change? Is there anything like a crystal ball that you can give to lenders to kind of look at it and monitor and say,
I
ah, I have to be
know,
prepared for
I
this
know.
next thing?
It's tricky, but I think that the CFPB does have requests for comments that they initiate, and they just sent one out recently, and a request for information about mortgage fees
Yes.
specifically. And I know that they're charged with trying to reduce this because they've gone up so much. I think they said 30% within the past several years. Of course, one of the reasons is because we have so much more compliance costs, which is because of the CFPB's
Yes.
impact. But they did say they really do want feedback from the mortgage industry as well, because there are things we can't control, things like the credit reports and appraisals, and those costs have gone up as well. So I think certainly we have the opportunity to try to give our feedback, and I think the MBA in particular is great about. We've got a great lobbying effort. They are always aware of what's going on, and they're educating their members on that too. And so when there's something that's CFPB has announced, or that's going to be a challenge, or one of the agencies, Fannie or Freddie, the MBA is really quick to provide feedback on the issues that they see that are going to arise with the industry. And so the hope is that the agencies, the regulators will take that feedback into account before they make implementations to new regulations or new requirements. So I think we're very lucky to have such a strong advocate in the MBA, this our organization is very good about educating its members too, and so.
Dan, given your experience in mortgage banking, would you recommend a career in our industry to a recent college graduate, for example? And if you do, why? And if you don't, why not?
I have really loved the industry. I like the fact that we're ultimately helping people get into homes, and I think that end result sometimes you forget when you're in your
Mhm.
daily world. Certainly, it's a little bit of a challenge right now, just because the industry is a little down with the mortgage rate so high. So somebody graduating today might have a little bit of a challenge finding a job in the mortgage industry, because we're just we're trying to kind of tighten our belts until things improve. But I think that if you can find a really good mentor and get a good knowledge base, you can make yourself be a good candidate for really being a help to a mortgage lender or a servicer, someone in the mortgage industry. So I think a lot of it is just finding the right niche for you and finding somebody that can mentor you, because there's a lot of information. It's a very as I was saying in the beginning, one of the reasons I wanted to pursue the CMB program was because there's such a broad array of information and things that impact the industry. So getting into it, it can seem overwhelming when you're first new to it. And I think having a mentor that can help give you some guidance really makes a big difference.
Absolutely. Absolutely. And I hope that our society, the CMB society, could be a source of mentors for those
Mm-hmm.
young people as well.
Mm-hmm.
I want to ask you, and if you could change one thing in the mortgage industry to make it either more efficient, more inclusive, more innovative, what would that it be, and why?
I think some of the challenges that we have are due to the complexity of all of the requirements and compliance issues that we have. And I think that while we need the regulations, as we said, because having none or having very little was not
Mhm.
good either, I think the problem now is that it's gone maybe too far the other way. And I think a borrower who's going in to sign a mortgage document is just going to be overwhelmed, right? It's a lot of information that they probably can't understand. I know that the trade documents, aim to help that, but I think we've gone a little bit too far now with the amount of disclosures and notices that they have to be given. And so if there was a way to, I think, simplify the process slightly and make it more borrower friendly, that would be really helpful, because it's just, a borrower is not going to buy a house every day, right? And so this is a couple times in their lifetime, perhaps. And so they don't understand the process very well. And looking at this, it's like, it's got to be overwhelming to them. So I know that most of them probably aren't reading them and they're just sign here. But I think that to the extent we could really make it easier for borrowers, that would be really helpful.
This is an excellent thought and advice. And I think it's a challenge to the industry, I would think, because as you said, those disclosures are so long, so many of them.
Mm-hmm.
And not only in our industry, every industry has their own unique challenge from disclosures and compliance.
Yes.
But ours is really something else.
Yes, it's got to be one of the. I mean, I think it is one of the most highly regulated industries that we have out there now. And I think, like I said, probably an overreaction to the issues back in 2008. So we've tried to compensate, and I think we've done a good job. And of course, the industry is following guidelines that we've been given. We have to give these disclosures. They have to say this, and this. So there's not a lot we can do. But I think that's an issue that I think would be nice to remedy.
Yeah. So with that thought, let's all keep thinking how we can innovate and how we can make those disclosures more meaningful for the borrowers. And yes, and thank you so much, Diane, for setting this time to talk to us and share your insights, your wisdom. And I hope to see you on another show.
Thank you so much. I appreciate you having me.
That's all for today's episode of CMB Connect. Thanks for tuning in, and remember to subscribe for more conversations with industry leaders. Until next time, keep connecting, keep learning, and keep pushing the boundaries of innovation. This is your host, Val Buresch, signing off.